Welcome back to Options Insights, where I walk you through real trade decisions and scenarios and the thinking behind them, so you can better manage your own positions with confidence. Today's topic: what do you do when a cash-secured put goes in the money? You've got three main choices: accept assignment and buy the shares, roll the contract straight out to a later expiration, or roll down and out to reduce your strike price. We'll look at all three through the lens of a real trade that I placed on NVDA. But the logic works no matter which stock or ETF you're trading. On March 15th, with NVDA trading at $120.98, I sold a cash-secured put with a strike price of $105. I received $132.34 in premium. NVIDIA has since dropped below that strike, and my contract is in the money, expiring in 3 days. So I'm deciding what to do next. Now let's look at the numbers for each of these three choices if the trade ends in the money. After we look at the trading screen and spreadsheet, we'll come back and analyze it a bit. If I accept assignment on Friday, I will pay $10,500 for 100 shares of NVIDIA. I will have received $132.34 and then paid $10,500. My break-even point, or the average investment for these 100 shares, will be $103.67 apiece. I might also consider rolling the position straight out to May 30th, keeping the same strike price of $105. If I choose the straight roll choice, I can bring in between $415 and $425 in income. For the sake of the illustration, I'll say $420. And if I roll the position down to a $102 strike with the same expiration date of May 30th, I'll bring in less income, but I will lower my strike. With a strike price of $102 and a May 30th expiration date, I can bring in at least $240, maybe $250. So for the purpose of this illustration, I'm going to use $245 as my income. Now let's take a look at the break-even price if I am assigned to buy shares under each of these three scenarios. If I accept assignment on Friday and pay $105 per share, I will have received $132.34 for the first put and then spent $10,500 for 100 shares. My total out-of-pocket will be $10,367 and some change, and my average investment per share will be $103.67. If I choose the straight roll, keeping my strike at $105, and then am assigned on May 30th, I will have received options premium, received premium again when I roll, and then I will be assigned to buy at $10,500. My total expense will be $9,947, and my average investment per share will be $99.47. If I roll down to the $102 strike, I will receive less premium for the roll, but I will also pay less for the shares if they're assigned to me. If I am assigned at $102, my average investment per share will be $98.22. So which one should you choose? There is no magic formula, and one choice is not necessarily better than another. You just need to understand the risks and benefits and know that your goal matters more than the math. So let's take a minute and look at the risks and benefits. The benefit of accepting assignment right now is you own the shares and can hold them for growth or even start selling covered calls. The risk is you lock in the current strike, and if the stock keeps dropping, you're exposed to more downside. The benefit of rolling straight out is higher premium, with more income up front. You get a better annualized return as well, which I'll discuss in another video. The risk is you're keeping the original strike, and if the stock keeps falling, you're just postponing the problem, but at least you're getting paid to do it. The benefit of rolling down and out is the lower strike. You have less downside and a lower break even. The risk is you collect less premium, and if the stock recovers, you might miss out on buying it at a great price. So which choice best matches your goals? If you want to own the stock and are still bullish, either accept assignment to buy now or roll it straight out for more premium. If you want to further reduce your break-even before buying, roll down and out, but understand that the lower strike price also means you'll receive less premium for the roll, and the difference may not be that great. Are you trying to exit the trade entirely? Roll down as much as you can while still generating a net credit. Accept lower premiums in exchange for increasing the chance that the contract will expire worthless. It may take more than one roll to get there, but if you are trading quality underlying positions, eventually you can usually find an exit point that leaves you with some profit. There is no one-size-fits-all answer. The right move depends on your risk tolerance, your cash flow needs, and your conviction about the stock or ETF. In my case with NVDA, I weighed the break-even prices, the total premium collected, and the potential outcomes, and made the choice that best fit my current strategy. If you want to keep seeing real trades broken down like this, hit the like and subscribe buttons, and if you've ever wondered why your option trades don't behave the way you expect, check out my beginner-friendly guidebook linked in the description.